Hello everyone, welcome back to Billionaire Consulting. Today, we're turning the spotlight on a cornerstone of finance, the time value of money. It's a fundamental principle that influences every financial decision, big or small. The concept of time value of money is central to understanding how the ticking clock impacts the worth of our cash. It's about the potential of your money to grow over time and how inflation can erode its purchasing power. Intrigued? Let's break it down with an example. So, what exactly is the time value of money? Well, think of it as a principle that tells us a specific amount of money today is worth more than the same sum in the future. But why is this so? The answer lies in two things: potential earning capacity and inflation over time. Let's look at it this way. If you have $100 in your pocket right now and you decide to invest it sensibly, it could grow over time due to interest or returns. But if you decide to hold on to that $100 and wait a year, you'll find that it doesn't have the same purchasing power. This is because of inflation and the missed opportunities for investment. So essentially, the time value of money concept helps us understand that money isn't just static, it's dynamic, and it's impacted by time. Now, let's get into the nitty-gritty of how to calculate the time value of money. There are various formulas, but one common method is the future value, FV, and present value, PV, calculations. These are two sides of the same coin, helping us to understand the time value of money from different perspectives. Future value calculation projects what a current investment or a sum of money will grow to be at a specific point in the future. It factors in the rate of return or interest rate and the time period. A dollar today could be worth $2 5 years from now, given a certain rate of return. On the flip side, present value calculation tells us what future money is worth today. Why would you want to know that? Well, it helps us to make apples-to-apples comparisons of money across different time frames. These calculations might sound complex, but they're essentially just mathematical tools to help us understand the impact of time on the value of our money. Now let's discuss how the value of money can erode over time. Inflation is one significant factor. As prices rise, the purchasing power of your money decreases. This erosion of value over time can be likened to a sandcastle being slowly worn away by the sea. Every wave of inflation reduces your money's purchasing power, bit by bit. Now, what can we do to strengthen our sandcastle against these waves? The answer is investing. By strategically investing your money, you can not only bolster the value of your money against inflation, but potentially grow it as well. It's like building a protective wall around your sandcastle to guard against the sea. Investments come in a myriad of forms, from stocks and bonds to real estate and small businesses. Each has its own potential for returns and each carries its own set of risks. Some investments may offer high returns but come with a high risk of loss. Others may be safer, offering lower but more consistent returns. So how do you decide where to invest? Well, that depends on your individual circumstances. Your risk tolerance, time horizon, and financial goals should all play a part in shaping your investment strategy. Do you have the stomach for high-risk, high-reward investments? Or are you more comfortable with safer, steady returns? However, it's essential to assess your risk tolerance, time horizon, and financial goals when choosing investment avenues. Diversification is often the key to managing risk and optimizing returns. By spreading your investments across a variety of assets, you can balance out potential losses with potential gains, helping to protect and grow your wealth over time. And there you have it, the time value of money. An essential concept that shows money today is worth more than the same amount in the future. To make wise financial decisions, keep this in mind. Until next time, stay financially savvy.